This is property and casualty insurance finance, right? It's not property and casualty insurance, it's property and casualty insurance finance. So it is a finance class. Good for you, right? Because if it was property and casualty insurance, we'd spend the whole semester reading insurance contracts, which is not real fun, but we're going to do finance, which is a little more entertaining. Unusual class for you to take. If you're an actuary, this is a field you might work in. So how many actuaries do we have in here? That's two. All right. So the rest of your finance majors, you could work in this industry. I had some students interviewing for Blackstone for a job that supported the insurance industry, and they were calling me. I was on my bike talking to them for 2 or 3 hours almost every day. So it is helpful if you interview with USAA or interview with an insurance company. It is helpful to know. If you want to analyze insurance companies, they're tough to analyze, and property and casualty insurance companies are very different than life insurance companies. They're like two different industries completely. So this help that. And then just basically, you got to buy insurance. So this class has some practical to it. Definitely can help you if you're buying auto or homeowners insurance. If you want to do financial planning, we'll talk through the financial planning aspect of it. We won't quite take it to the detail on financial planning. If you're going to know financial planning, you really have to understand how each state is different and the rules. We're not going to get into state-specific stuff because it just gets really complicated. I find it fascinating. There's a few parts of this class where it's not my forte. So I'm Ron Sweet. I retired from USAA in 2009. Spent a lot of time on the life insurance and property and casualty side, so I feel comfortable with it. Problem is, USA doesn't sell commercial insurance. That's not my strength. However, I now have some contacts on the commercial side that I'm going to be asking them to come talk to the class. So we might have some outside speakers. Some of you that went when we had the insurance conference last semester, some of the speakers there were, two of them were from the commercial side. So hopefully it can get set up on the commercial side. This is an industry that generally gets a lot of bad press. I don't know if y'all have noticed some of the congressional testimonies been going on. Allstate, some of the others are really getting beat up. If you're buying insurance, you probably noticed your insurance rates are really high right now. Have y'all noticed? Increasing like 30–40%. We'll talk some about that. Insurance you have to buy, but you don't have to buy all of it. So we'll talk through that. On auto insurance, I don't buy parts B and C, but I bet almost everyone in here does buy B and C. I think B and C is a waste of money, but I doubt I can convince you of that. You'll have to decide. But you're spending a couple of $100 on something I think is a waste of money. So insurance is required by law, but the law doesn't require you to buy A, B, C, and D. It only requires you to buy what? What insurance do you have to have in Texas? So D is collision. Do you have to buy insurance on your own property? So what do you have to buy? A, liability. So you'd have to buy A. You don't have to buy any of the rest of it. Probably most of y'all buy all four parts. And why do you buy all A, B, C, and D? Probably if you're like most people, you just never thought about it. That's what everybody does. Do you ever want to buy insurance and not think about it? We'll talk through insurance. Have y'all done net present values in your classes? You remember doing net present value? What's the net present value of insurance? Always negative. You always are going to get back less than what, on average, you could win the Jeopardy, and you spend $100 on auto insurance and you wreck your car right away, and they pay you $20,000. It's possible, but on average, you're going to pay them more than they pay you. So do you want to do a lot of a transaction where you're paying more than you're going to get back? Probably not. So insurance is something that you don't want to overuse it because you're paying more, because the insurance company has expenses, they have adjusters, have all this kind of stuff. So if you pay them $1,000, you're probably going to get about 65%, 70% back. The other 30% is going to go to the insurance company for profits and expenses and those kind of things. So it's important to know what you're paying for. We'll talk about the concept of rate online in this class. I think it's a really good concept that you should look at. You can do it. I know my insurance company, I use USAA since I was there. I can go online and USAA can price. What if I cancel B? What if I can take my deductible up to 1,000 instead of 500 or instead of 100 or whatever, and see how the premium changes? That's what we're going to talk about rate online. How much more premium are you paying versus the extra protection? And you want to do that in kind of the sweet spot, so you spend the right amount of money. So there is a practical side of this. I don't know how many of y'all are interested on the financial planning side. That's not my favorite field of finance, but there's a lot of people who like to do that. If your field, you really have to become an expert on taxes, property insurance, life insurance, investing, trust, all kinds of things. You have to be really an expert on all of that. So here's your property casualty side. Fortunately, on the property casualty side, if you decide to go that route, there are exams you can take, the CPCU, COU, that really help you on that. So you can get more in depth. So we're going to talk about this industry. I really do want to focus on it from a finance standpoint. So we will talk some on from the economics and the finance side of it. This is face-to-face. I do require attendance. So some students hate that, but I'm not going to talk to a computer screen my whole life. COVID has changed people's perspective. It used to be the easiest thing was just showing up, and now it's like just showing up is like the hardest thing in the world. It's like some people are like, I don't even want to get in the car. I want to get out of my pajamas. I just want to sit home all day. And people are even doing that on the job, right? Man, I talked to several alums, talked to over 100 alums last year, and I'll probably do another 100 this year. A lot of them are working in the office 2 days a week, and the other three, they're at home. Boy, that kills your career. That would have been horrible for my career. My career was really helped while walking around and talking to people. So you really want to come here, interact. You can miss classes. You can miss up to 3 and send me your notes watching the YouTube video, and I'll give you credit for those 3. After that, it starts hurting your grade a little bit. Doesn't really become devastating unless you miss like 20, 30% of the class, then it starts becoming an issue. If you're going to miss more than half the classes, drop the class. There's no reason to come. You're wasting my time, wasting your time. But it is an in-person class. Course materials. I've looked at a few property casualty insurance textbooks, and they're really horrible. They're really dry, really boring to read. So we're just going to use my class notes, which is perfectly fine. Saves you some money, right? What are y'all paying on books now? What's a typical book? Is it over $100? Even though it's not even in paper? Isn't that crazy? When I was in college, like 87 years ago, all of my books for all of my classes for 15 hours was less than $100. I could buy books for 5 classes and it wasn't $100. My entire tuition, fees, books, the entire thing, I never had a semester over $500. So it's just ridiculous how expensive it's getting. Would you pay $100 for any book in any situation outside of college? Doesn't make any sense, right? It's just crazy. So, and the Economist wrote an article, who's making the money off of this? And they couldn't answer it. Not the publishers, it's not the writers. Like, well, someone's making money on it. It doesn't cost them $200 to give you a PDF online, but I don't understand. But I'm not going to play that game. So you have essentially 4 things in this class, just like my risk management class. If you're taking that, 2 exams. The first paper, which we're going to get in tonight, because that's really the only thing you need to be worrying about right now, is getting that first paper going. It's a really straightforward paper. The second paper is a paper of your choice, so I'll give you some topics. I'm actually thinking about, well, I'll decide this, get closer, that we might not actually do it as a paper because of AI. I don't want to read your AI papers. So it might actually be a presentation that you make instead of that. It takes me, I can grade about 6 papers an hour, and we can do 6 presentations an hour. So it takes me about the same amount of time. And it eliminates that issue. We'll see. We'll talk through that. So attendance, if you're perfect attendance, that includes with the 3 makeups, you can get a 2% bonus. If you're going to miss a lot of classes, just drop the class. Don't even try. If you do the instructor survey, you get an extra 10 points. So my office hours, Tuesdays, Thursday is the best. Monday, Wednesdays, the Investment Society has the dashboard team, which you're more than welcome to attend. I highly recommend it if you're a finance major. On Monday, we do our weekly market outlook, which we write a podcast, or we write a blog and create a podcast. Um, the key there is we're talking about what happened to markets the last week. So if someone goes in an interview, they know all the terms to talk about. And on Wednesday, we're going to do a dashboard where we're going to do stock valuation. We're going to value 2 or 3 stocks a week. We have a live portfolio now. UTSA is doing really, really well. We've had it for 3 months now. It's beating the S&P by quite a bit. But what we're going to do on Wednesday is take stocks in our portfolio and do a quick updated valuation to see if maybe we should sell them. We own ACMR and it's up over 50% in just a couple of months. We're like, well, wow, maybe we should cut back on that and see what's going on. So that's what we do on Wednesday. So Monday and Wednesdays, I'll be a little bit distracted, but Tuesday, Thursdays, very undistracted. I also am on a bike every morning. We'll see how Thursday and Friday and Saturday go this week, but I'm on a bike every single morning. I mean, literally every single morning. I've been on a bike every morning. I hit 10 years back in March. I'll hit 4,000 days in a row here in a couple of weeks. So you can call me in the morning and I'll be on a bike. I might be breathing heavily, but I'll be on a bike. You can talk about the class. You can talk about careers. There's all kinds of things. So I'm more than well. I've had some really long career discussions with students on my bike in the mornings where they're going through all their different options and talking about it. I know quite a few industries pretty well. My forte is insurance and banking, and I know the investment side. And then I've worked with a lot of actuaries on both the P&C and life and benefit side. So if you have those kind of questions, I may not be able to answer your questions, but sometimes I can definitely give you a contact to talk. You know, if you're trying to decide between P&C or life, actuarial science, you know, which side you're going to go on, I can certainly give you contacts to talk there. So feel free to call me anytime in the morning, but I will be on campus Tuesdays and Thursdays in the afternoons, and I'll be here on Wednesday, may be distracted a little bit on Wednesday. You can call me. You can email my personal email. That's the safest. If you email my UTSA, I will get to it. If you text me, I'll try to get back to you, but I'm really bad about forgetting texts after I read them. I'm on my bike on a steep hill. I see your text, and then 10 minutes later, I forget that you text me. So email or phone call is probably the best. Although I have a new phone and I haven't figured out why it won't ring. So you'll probably get my voicemail and I say, oh, I got a call. So, but I'm very open to talking. So there's your class. We'll start off. We are going to talk about paper one here quite a bit here in the first couple classes, but we'll start off with just the economics of insurance in general, but really focusing on property and casualty. Why do we have insurance? Why are you paying for something where it costs you $100 and you're only expected to get $70 back on average? Why in the world would you do that? And understanding this industry some. The paper one is part of the economic basis. So you might be finding it really weird. I'm using such an old paper. It's a very famous paper. It was written in 2001. Anything happened in 2001 that might impact the insurance industry? No. 9/11. Yeah, 9/11. So Berkshire Hathaway was insuring the towers. As tragic as the human life was, you also have the property side, which doesn't seem important, but it's still billions of dollars. So in 2001, Warren Buffett, the now retired CEO of Berkshire Hathaway, he wrote in his annual report, The Economics of Property and Casualty Insurance, and became really, really famous for what word? What one word did he use? What is he famous for? It starts with an F, and it's not a bad word. Any guesses? You might do it on the river sometime. Float. All right, so we're going to talk about float. Now, he's written about that a lot since then, but not like he did in 2001. The 2001 was so I want to use that. It's really well written. All you have to do is go on YouTube, or not YouTube, just anywhere and do Warren Buffett and float, and all kinds of things will come up. He says it's a secret to his business, how he makes money. Why is that? Well, we'll see. If you have Geico auto insurance, he makes it real clear you're not a customer. You're a cheap source of capital. He's borrowing money from you and paying you on average a negative 5% debt cost. Would you borrow? How much would you borrow if your cost of debt was negative 5%? So, hey, I loan you money, you owe me negative 5%. So if you borrow $1,000 from me, you'll have to pay me back 950. How much would you borrow from me? 2 trillion, right? Maybe. So that's how he views his Geico policyholders. They give him $1,000. He pays 950 on them and employees and everything else. He pockets $50. That's what he calls float. You won't say that on the life insurance side. It has nothing to do with life insurance. It only works on the property casualty side. So insurance float, the secret behind Warren Buffett. And there's a lot there. I mean, you can, and this is important because in paper one, a good chunk of paper one is you going out and finding more stuff. Now, can you use AI? You can use AI, just don't copy and paste AI, but you can certainly, some y'all try ChatGPT. What does Warren Buffett say about insurance float? Or I don't know how you could do it so you get kind of someone else's perspective that people disagree with them on that. But that's the focus of the first paper and a big part of this economic. Once we get past that, it becomes very product specific. So we'll do homeowners, and you'll notice what we do with homeowners. We talk about homeowners, and at the very end, we're going to do a special issue for homeowners. So let's see how much y'all think about this industry. What would you think would be the most overwhelming issue of homeowners? What do you think insurance companies think more than anything else on homeowners? Maybe on Friday and Saturday, what are they going to think about? You may have this as a pet in your house, and it's not a dog. Any guesses? What is a cat? What does CAT stand for? Catastrophe. Homeowners is worried about earthquakes, hurricanes, floods, maybe not so much on floods, but we'll talk about floods. The insurance industry doesn't insure floods, but floods is in there. They're worried about catastrophes. That's a huge one. Texas is one of the worst states for catastrophes. We get hurricanes, we get winter storms, we get tornadoes. Any of y'all live in Dallas? Dallas is actually one of the worst cities in the entire state, in the entire country, because they get everything. Winter storms are really bad. We'll see what happens on Friday, Saturday. Do you want Texans driving in icy roads? Not generally, right? Doesn't look, roads aren't really set up for it. They don't have the equipment in Dallas because they're not set up for it. So catastrophes. So we're going to talk about catastrophes, and in particular, we're going to talk about catastrophe bonds. And I have an expert that I discovered last year. A friend of mine at Victory Capital connected me with this person that actually does catastrophe bonds. They're called cat bonds, but catastrophe bonds. Can you imagine there's a bond that's tied to catastrophes? It's a bond that if there are no catastrophes, you make a high return. If there are catastrophes, your bond return comes down. Really, really interesting stuff. We'll talk about that. And that will be the math problem on exam one, will be catastrophe bonds. All right, we'll look at it. It's really, really interesting. I don't do it exactly correctly. I have to modify the question a little bit. I make it a fixed rate bond. They're actually floating rate bonds, but I can't actually do floating rate and make the question doable. So I'll simplify it. But if I can get the expert to come talk to us who hear the real world, I love catastrophe bonds. They're extremely interesting from an investor standpoint. You might say, why would I want to invest in something where I can lose money if there's a hurricane? But they're very interesting bonds. So at the end of homeowners, we'll talk about catastrophes in general and then talk about catastrophe bonds specifically. Then we get into auto insurance. We'll talk auto insurance. And at the end of auto insurance, we're going to talk a really controversial topic there, which is credit scores. An old topic, but it's so timely today. Why in the world do insurance companies use your credit score to charge you? Do they charge you more if your score is low, or do they charge you less if your credit score is low? They charge you more. Doesn't make sense. Someone has bad credit, they're a bad driver. And what does the actuary say? Absolutely. And it's not close. It's not like it's there's kind of a trend that I can say it's absolutely, it's very, in fact, they say it's one of the strongest indicators that they have. And we'll talk some articles. It's an old one again, but it's so perfect for this class because it's an issue that we have a lot of data on because of the state of Texas. I used to have the former insurance commissioner of Texas has talked to this class. He's up in his 80s and he refuses to talk by Zoom. And the last thing I want is him to have an accident driving between Austin and San Antonio. It was really nice about coming up here and talking, very interesting. But I've heard him talk twice, and now he was the insurance commissioner when that issue came up. And so it's really interesting to hear his perspective on that. So I can give you his perspective on that. He was a really impressive guy. To be insurance commissioner, he had to be a CPA. So in the middle of his life, he stopped everything, got a CPA, and then became insurance commissioner. So really sharp guy, more pro industry than you kind of expect sometime an insurance commissioner. Really, really impressive guy, really fun guy to listen to, but I don't want to ask him back. And so that would be our special issue on auto insurance. It won't be a math question, it'll be an essay question. We'll talk about the numbers behind that. Then we'll get into my least favorite topic, which is commercial. There are some pretty cool things here. We'll talk about mold in Texas and that issue. That really be more of homeowners, but it starts getting into the commercial side. And then hopefully I can get some guest speakers to talk specifically. One of the firms that spoke last fall, her firm does some really, really unusual insurance. She said she couldn't divulge it, but maybe we can get someone there that will talk some of the really, really unusual. I'm not talking crazy stuff. There are companies that sell alien abduction insurance, but I don't think that's a legitimate business. But there are some not quite that far off that are certainly interesting. Once we finish commercial, which includes workers' compensation. So we will do workers' compensation. That's not my area of expertise. I used to do presentations all over the country. And there was always the same three of us, and the lady was presented with me. She was a workers' comp person, so I got a lot of insight speaking to her. My boss finally shut that all down because I was getting all these headhunters calling me because I was doing all these presentations, so I couldn't do those anymore. But I got to meet her and talk to her. Workers' comp is pretty unusual. I don't know any other workers' comp experts, but I might be able to find one that would be interesting. So that's part of the commercial insurance. And then we'll get into pricing. Those that took my life insurance class, which Peyton and Sophia might be the only ones. I can't. What else? Oh, Aaron too, right? So, oh, Miles. Yeah. So remember how straightforward that was. This is not. It's quite messy. I do it like a finance person. I had a good friend, PNC actuary at USAA, and I developed this problem, and I showed it to her. She said, "Oh, that's all wrong." She redid it, blah, blah, and she showed it to me, and she got the same answer I got. And I said, "There's no way I can give that to finance majors because the math is way too advanced." So we're going to do it my simple way, which is not all that simple. You're going to see it's quite involved. It's quite a messy problem, but it goes through the entire process. I'm not a pricing actuary. I'm not an actuary, but I was heavily involved in insurance pricing at USAA from the investment side. So my goal was to give them the return on float, give them that investment return, because you pay a premium today, but you don't get paid a claim for 6 or 7 months. I had to say how much money were they going to make. So I worked with the actuaries very, very closely, which I love to do. They're the smartest people in the world. I always had a blast working with the actuaries. Sometimes brutally honest people, but smart people, fun to work with. We'll get some into the accounting. We'll see. It doesn't sound like a real exciting topic, but there are some unique things. If you go into an interview with an insurance company, you definitely want to understand some of the key ratios that they use that you will not see anywhere else. We're going to see them pretty quickly, though. Have you heard the term combined ratio? Anybody? Who's in here? Combined ratio. All right, so we're going to see combined ratio in paper one right away. You have loss ratios. You can probably guess what a loss ratio is. That's the claims they pay as a percentage of the premiums. And there's some other ratios that you'll see, risk-based capital ratios and those kind of things. But there are some unique things with property and casualty companies. And if we cover that, then if you do interview with USAA or you interview with State Farm or Allstate or someone, you can go look at their financials and get a good sense of what they're doing. A lot of these firms, USAA doesn't, but a lot of these firms do put what's called their statutory accounting, which is what they file with the states. And the nice thing about statutory accounting versus GAAP is it's incredibly detailed. So if I were interviewing with Allstate, I could get their statutory statement and I know exactly what businesses they're in. They're heavy in homeowners and auto, but they do a few other things that are kind of interesting. I can look at their risk-based capital. I can look at their investments, what investments they do. They do some interesting things. You cannot get that with GAAP financial statements. You have to do it with statutory. And a lot of publicly traded companies like Allstate, like Chubb, and some of the others, they do put the statutory out there. So if you're interviewing with a firm that's publicly traded, you definitely can get a lot of detail on the accounting side. And I'll show you some key ratios you can look at. With USAA, you'll just have to find someone there that knows about the business. Well, what does USAA sell? Pretty obvious, isn't it? Not much commercial, not any commercial. So homeowners and auto, that's the key. They do have a general agency. A friend of mine is on the general agency side of USAA, so I might ask her to come stock for things like motorcycle insurance, flood insurance, and there are some unique ones out there. USA doesn't sell motorcycle insurance, but their general agency does, which means you get insurance from another company. So yeah, so we'll get into that. The investing side, I could talk a long time there. That was my thing at USA. I was in the investment side for quite some while. And actually what happened, I was sitting at my desk minding my own business and I get a call and say, we're starting this new department called Strategic Investment and Analysis. And they want you in that department and you can't say no. So I said, okay. And our job was to spend a year doing nothing but asking how should a property casualty insurance company invest, because there was no research anywhere. No one had ever done anything. So for 1 year, 3 of us sat down and we ended up with 2 thick books of everything we researched. So I could spend the entire semester just on that. It is tough. There's really still not much research. The life insurance side, it's obvious what they're doing. Pretty straightforward. I don't know if y'all remember the ALM question on the exam last year. Pretty obvious, right? They buy triple B corporate bonds. Why? Because they need yield. They need spread. P&C is not a spread business. Banks are spread businesses, right? They loan out auto loans at 5% and they have deposits. They pay 3%. It's a spread of 2%. Life insurance, they get your money on annuity. They're paying 4%. They go invest it in a bond at 6%. It's a spread business. Property casualty is not a spread business. What kind of business is it? Starts with an F. It's a float business, right? Banking and insurance, life insurance is not a float business. It's a spread business. P&C is a float business. So the investment side is really, really critical to the property and casualty side because they get your money in advance. They pay you out over the next year. They get to invest it until they pay you. So the investment side is pretty important. The last topic sounds really boring. I actually think it's really quite interesting, especially on the property casualty side. This is a very heavily regulated industry. And it's an industry where the regulators are real picky on pricing. There's a lot of states that have insurance commissioners that are elected. You're not going to run for insurance commissioner promising to get auto insurance rates higher. You're going to promise to get them lower. So it's an industry that's really focused on pricing, and every state is different. In fact, in some states like Georgia, every county is different. So it's quite complex. If you're an actuary, a pricing actuary, you are going to be assigned a state. You're going to do all the work. Pretty fascinating work, and then they put it all together, they file it with the state, and then they just hope for the best. What do you think is an easy state? You can get whatever you want. Any guesses? Where? I don't know about New Hampshire. It may not be that easy, but it's kind of one of the smaller quarter states like Montana or something like that would be a hard state. Florida's a hard state, but I don't think because of pricing. Florida homeowners is a big issue, right? Because of the hurricanes. Like California's pretty rough, New York's pretty rough, Georgia has been pretty rough. So it's, it varies. So if you're a pricing actuary, which state you get is going to have a huge impact. Some states are file and use, like Texas, you file your rate and you use it. And unless the state comes back and complains, there's no problem. Some states like California and New York, they're in New Jersey, you have to file and get approval before you can use the rate, which means if the state drags their feet, you're stuck with the rate you're currently charging. And, until they finally give you approval, and they may not give you approval at all. The state of California several years ago voted to cut all insurance rates 20%, no matter who you are. And USA was like, well, we're already 20% cheaper than anybody else. Why should we have to cut another 20? But it's a very political issue. I actually think property and casualty insurance is better priced than life insurance. You're much more likely to get ripped off by a life insurance salesperson than you are a property and casualty. But life insurance, no one seems to really care from the regulatory side. They let them charge you whatever they want. Property and casualty side, because the law requires you to buy it, there tends to be more sensitivity to that. And even on homeowners, you may not be required by law to buy it, but your bank on the mortgage is going to require you to get homeowners insurance. So you have to buy it. So we tend to be a little more sensitive to it. Paper one is due in about a month. So that's why I want you to start on that. You can see the first exam is not until after spring break. So your biggest focus right now is on paper one. So we'll talk into that. All right, any questions on any of that? Everybody's good. All right. Now here's my class notes. 72 pages. We'll probably get through almost all of them. Plus, we'll have some articles and other things we'll use. On your paper, the paper is usually, it's going to be 40% on coverage, which I do have a rubric for paper one. Clarity is just how well you write it, and critical thinking. And in this first paper, critical thinking is also going to involve you doing some extra research on the float topic outside of what we talk about. So in clarity, those that have my risk management classes, very similar thing, how well organized it is, making sure your paragraphs are not too long. You can quote. I don't need a full bibliography, but make sure you make it clear it's not your words and somebody else's words. So according to is fine. And critical thinking, try your best to find something that really intrigues you and go into it more detail. Use words like, I find it interesting that, or a surprise, or I disagree with Warren Buffett because, or whatever you want to say, that shows that you have some engagement in the article. For paper two, I will talk more and more topics. Cybersecurity has been a big issue for insurance. Can the insurance industry handle cybersecurity? You think about some of these large firms like Target, they had a cyber hit some years ago. It's becoming more common. Now you're getting foreign governments doing this. So driverless cars is becoming more interesting. Have y'all used the driverless cars in Austin? Anybody? They're really expensive cars. I don't know why they're doing that, but I know Uber's starting to experiment with it. What is Austin? Is what, Waymo or whatever? So it'd be interesting. Would y'all get into a driverless car? No? I mean, their numbers are really good. They're a lot better drivers than humans, but it's interesting. There's a lot of articles on that. I spoke at USA a few years ago to the risk management department. Just hundreds of people. It's amazing how massive that department is. And this is one of the questions I brought up. This to me is a huge risk for USA, because if you had driverless cars, you don't need auto insurance. You're using somebody else's car. And then the question is, whose insurance is it? So if Uber invests in driverless cars, do you sue Uber, or do you sue the software company that put the software in the car? What went wrong? I don't know if y'all saw the video. The police stopped this driverless car, and the people inside we can't do anything. No one's here driving. I don't know who you're going to give the ticket to, but we can't do anything. And the police are like, come on, roll down the window. So there's a lot of issues there. Terrorism is not as big of an issue now, but that was a big issue, obviously, after 9/11. Regulation of insurance pricing, there are definitely some interesting topics there. We'll get into that more on the regulatory side, but there have been a lot of people asking, does regulation make it better for consumers or does it make it worse? And there have been some states like New Jersey that have, because of regulation, the whole market just collapsed. It just was a disaster and actually became a huge issue for the governor race. Global warming is always impact issue today. You can take any issue, any side of the argument on that. Is it making hurricanes more frequent? Is it making them more severe? Is there data to support that? And there is a website you can certainly use. I know President Trump was trying to shut it down, but NOAA, I forget what NOAA stands for. Oh, it's NOAA. So their website, you actually can go on their website and get a lot of really good data. One thing I did when I did that presentation at USAA, I took their picture. They have a picture of all their hurricanes for the year, and I just did every year and did it as a chart just to see, hey, are we getting more hurricanes? So this last year we had a lot of hurricanes, but nothing hit the United States. So even though the frequency is higher, it depends. And the temperature of the water is a big deal. El Nino, La Nina, that's a big deal. I think, what was it, Cuba or Haiti or Dominican Republic got hit with a big hurricane this last year, but the United States, nothing at all. But they do have a database where you can go back. I forget where it is in here. You could find it. I will be showing it when we talk about catastrophe risk. But they do have a map that shows all the hurricanes, where they hit. And it's interesting, like if you look at Katrina, Katrina was interesting because it hit twice. Hit Florida, went out back in the Gulf, strengthened and hit again. So it had like a double whammy on the United States, but wasn't as impactful for the insurance industry because most of it was flood, or a lot of it was flood. There was some non-flood in there. But you can see that, get those charts and get a little bit of sense. When we can't do it now, we should have this class in the fall instead of the spring because we don't get hurricanes when the water's cold. So there aren't any hurricanes in the winter months, but in the fall, that's when you can see them. And if y'all have ever seen their charts, you probably see them on TV shows, right? They're showing, and they have like this cone that shows where it might hit. And if it hits 10 miles further north or south, the dollar loss can be massive. So there's a lot of data to do there, but there are other catastrophes besides just hurricanes. So in California, they've had the fires this last year. They blame that on an electric utility. You could even write a paper on the catastrophe risk of electric utilities. Would you want to be an insurance company insuring an electric utility that can be sued if their equipment starts to fire? That would be an interesting topic by itself. This one I don't think is an issue anymore. COVID is no longer, it's a little too old. I actually had, I tried to contact her a few years ago, but she wrote a paper on COVID-19 and its impact on the industry, and it was an impressive paper. I don't know where she got all that information. So what happened with COVID? Well, as a cyclist, I noticed immediately there was no cars on the road. I was like riding all over the place. Very few cars. That sounds good for auto insurance, doesn't it? Anybody know what they actually discovered? So fewer people were driving, but what happened? Frequency came down. What went up?
I was going to say, like, maybe people just cancel their insurance.
No, they kept it. And I got a big bonus from USA because they said we're going to, give you a dividend back. But then they were surprised later. So y'all know what frequency is. That's the number of accidents. What's the other side? Severity. What's that? The average loss. So frequency came down. What happened to severity? There were so few cars on the road. What were people doing? They were driving 100 miles an hour. So the severity shot up. So insurance companies at first said, wow, this is really good. Then they discovered, wow, our losses were worse than we expected. So there was a COVID-19 impact, but that's a little too old. This one is still a really good topic. Insurance for the gig economy. There was a company that got started just to do this. It's called Buckle, and they buckled. They didn't do well, but that was what they're going to do. How do you insure Uber drivers? How do you insure DoorDash drivers? Those kind of things. And sounded really interesting, but they just couldn't get the business to work. But pretty important. Now, I don't know how many Uber drivers are getting insurance as Uber drivers. A lot of them probably just saying, I'll just rely on my insurance, but good chance their auto insurance is not going to cover them if they're doing business, if they're doing a business. That's one of the exceptions for your auto insurance. If you're in a business driving your car, that's not going to be covered. That's commercial insurance. So that's a good topic. There's a lot of gig economy going on. There's others that I can think of quite a few. One I think is really good is cat bonds. Now that we have this contact, he sent us some really good articles and papers. So if you're an investment person interested in some interesting investment ideas, catastrophe bonds are, I'll explain why they're such a wonderful, interesting investment. They're very unique versus other bonds. I love talking about it. So cat bonds is really good. There are other topics out there. One thing you could do is go to some of these sites. I'm a huge fan of Swiss Re. It's one of my favorite companies. It is a reinsurance company. They came to USAA once, and I just sat there going, man, I wish worked for this company. They were first all excited people about their jobs. They love their jobs. Very brilliant people. A bunch of actuaries there just love what they do. Look like a very fun group of people to be with. But yeah, if I were an actuary, I would say this is my ultimate goal, is to work for Swiss Re. But they do have a database where they talk different issues. What about AI and insurance? This could be the process side, could be the claim side. Is AI going to change how insurance companies operate? Now, I don't want just generic stuff that every firm's using AI to do whatever, but specifically. So this one is really interesting because there's a company called Root. This would be a really fascinating topic. I know I'm switching out of Swiss Re here, but Root Insurance. So what Root Insurance does is they provide auto insurance, and when you buy it, they're going to charge you a high rate, but then they're going to give you telematics, where they're going to monitor you driving, but they're going to use AI. They use AI to determine your ultimate rate. So if you think you're a really good driver, not just that you don't have many accidents, but how quickly you stop, how fast you start, do you speed, how do you take corners, all that's that the telematic is collecting, they're going to use that with AI. And if you're a really good driver, you should see your rate drop dramatically. So this is an interesting company where they want to provide insurance that's specific just to you. Exactly how you drive, where you drive, how fast you drive, all those kind of things. So it's an interesting company. So you might even go on their site, be part of your paper, go on their site and actually put all your information in and compare it to your current insurance and see if it's something interesting to you. That's another topic that's extremely interesting. Telematics. You don't know what telematics is? Telematics is. So for me, it's something on my phone where USA monitors my driving. They tend to monitor only one thing, and it's, am I using my cell phone while I'm driving? Which I never do. I just set it over to the side. But they're monitoring your driving. Telematics is a huge thing, but telematics with AI is even more interesting. But let AI decide what are those characteristics that help. So it's kind of strange. I mentioned credit scores. When we talk credit scores, people don't like having to pay 20-30% more insurance because they have a low credit score. Some people think telematics might replace that. So instead of using credit scores, we'll look at how you actually drive. So if you actually have a bad credit score, but you're a really good driver, telematics is going to tell the company that, and your credit score won't affect you anymore. So there's some interesting topics there. So Swiss Re site will give you some really good, interesting topics. Digital transformation. You don't worry about longer living. They do the life insurance side as well. That's not our issue here. But climate risk, they have a whole section on climate risk. I just can't click on the bottom. So good papers and articles and stuff. So it's a really smart firm. It is an actuarial firm, so you're going to get some really good technical topics. Yeah, all kinds of really, really good. And see, it's just the word cat. So get used to that. I made a mistake. I met one of my heroes, Dr. Ibbotson. And the first time I met him, I asked a question about cat risk. He had like no idea what I was talking about. What's cat risk? It's like, it has nothing to do with cats, it's catastrophes. So in this industry, we never say the word catastrophe. We're too lazy. It's just cat risk, and you know exactly what we're talking about. So Swiss Re is a good site. If you're an actuary, these two sites are really, really good. RMS is a modeling firm. They do catastrophe modeling or cat modeling, owned by Moody's now. I keep forgetting. They have a button called Insights. You want to look for the property and casualty side, so physical and transition risk. They have a whole section on artificial intelligence. So RMS is famous for modeling earthquakes. So they're an earthquake modeler. They do hurricanes now, but they started off with earthquakes. So that's their expertise. And then air, what do you think? How do you think air started modeling? What risk were they modeling? Huh? No. You could do that, but here it's hurricanes. So they're a hurricane. Yeah, there's something that's not how I never know if they got bought out by somebody else. So it's possible that their website changed. It looks like they got bought by Verisic. So I don't know Verisic at all. So that happened just recently. You can see hurricanes is the first thing that comes up. So it might change out to Verisk. I don't know them, who they are, but a lot of stuff. So if you're looking for a topic, you might try some topics there. One other thing I don't have on here is it's a podcast. I think Sophia, I might have given this to you or Peyton or someone. The Not Unreasonable, which is a really strange title. I think he stopped posting. So it's been a while. So actually we might listen to his D&O one. Is really, really good. But so for some reason he stopped posting 3 years ago, but the topics are still really good. They're still pretty timely. Flores insurance overhaul, pricing insurance risk, death spirals, and other selecting problems. So there's some good topics there. So you might try that as an opportunity. Nice thing about that is you have a good podcast that gets you the high level, and then it gives you some terms you can look up for a little more research. Paper 2 is not a research paper. It's just a paper. So what you're looking for with a topic for paper 2 is a really, really solid one article that's 10 pages or so, well researched, or 4 or 5 shorter articles that get into the topic, especially like with autonomous vehicles. There's so many articles out there that the 3 or 4 of them together. I read The Economist every week. They've done several articles on autonomous vehicles that are very interesting. Make sure whatever the topic is, it's a property casualty insurance topic. I'm not asking about autonomous vehicles for you as a customer. I'm talking about the impact on the insurance industry. So be clear on that. But there's a lot of topics that we can certainly do here. There's probably some other sites we could look at. All right, so you don't need to worry about topic paper 2. However, the advantage is if you start thinking about your topic early enough, then if you see a podcast or a news article or newscast or news article, you can grab it and bring it in. The Economist is great. You can just go on the Economist site. I highly recommend getting an account with the Economist. I think they have a student version. I love their articles. Someone in my class last semester said it was some communist rag or something. I forget what they said, but I think it's actually really, really well written. Yeah, they have a bias and their biases come out, but their biases are not as extreme as other sites. And they cover topics pretty deeply in a pretty solid article. So Economist is a great source, but there's other sources. Websites are good in this industry. The reinsurers are really, really good. Insurance companies themselves, like Allstate or Farmers or whoever, Chubb, they tend not to have good research. We can try Chubb, what their website has, but yeah, they tend not to put research out. Some firms do, like Exxon, you go to Exxon site, they have all kinds of stuff on the energy industry. So there are firms that do that, but remember Exxon, they're kind of hated because they're producing carbon. And so they're out there, they have a public relations issues they got to address. Insurance companies, they don't tend to put research out on their site, but the reinsurers are the exception, just because of just the nature of their business. They're considered to be research kind of consultant businesses. So start thinking about your paper two. We'll get into it in more detail. All right, before we do the economics of insurance, let's talk about paper one, because that's what I want you to start on. So on Canvas, under module one, you have the Berkshire Hathaway annual report for paper one. I don't know if I did anything. And here's a description of paper one, which includes a rubric. Make sure you're really, really clear. I usually put it in the notes, but I didn't hear. You're not reading the entire annual report. You're reading pages 6 through 13. All right, be really clear on that. You'll know because at the bottom of the page, it says the economics of property and casualty insurance. All right. We're just reading from page 6, numbered page 6. You notice numbered page 6 is page 7 of the PDF, but numbered page 6. This was written before you were born, but it's still very, very timely. Trust me, I've read his updated ones in the last few years, and he says the exact same thing, but just in about 1/10 the space, because this was a big deal. Now, your paper one is not to summarize this. Your paper one is to follow the rubric, because we're going to discover that we're going to pull stuff out of this article that Warren Buffett didn't say. We're going to do some reading between the lines. So it's the article plus the class discussion. Okay. So take really good notes. A good example is each says there's 3 concepts that it comes to understanding the risk insurance companies are taking. We're going to take those 3 and probably convert them into 6 or 7. Okay. This is somewhat the key to this right here. What he said is, boy, we lost a lot of money in 2001. What did we learn out of 2001? That's important for us to learn going forward. All right. He says 3 things, but when you read like number 1, you'll see, wow, there's like 3 things just in number 1. All right. So you got to make sure when you do the paper, you're following what we're doing in the class. Also, he gets into this issue of experience. I'm trying to find the other word. Experience versus exposure. I don't see the word exposure yet, but experience versus exposure. Oh, there it is. This is a huge part of the paper. A lot of students miss because it's not in this list of 3 things. Experience versus exposure is essentially experience is relying too much on your history and ignoring what you really are exposed to, that what could happen differently going forward. And that's a big part of this. This is probably the part of the paper students lose the most points. So I'm going to try my hardest not to have that happen this semester. And this is the part where we're going to read stuff in here that's not in this article. All right. I'm going to say he's saying 2 things, but he never says the 2 things. He implies them. So make it real clear. He says there's 2 ways experience can mess you up, but he doesn't come out and say the 2 ways. He implies it. but you got to know what those two ways are, right? And there's two areas. We'll talk about them more in detail, but one is when you're insuring something where there's just not much history, like terrorism risk, when you don't have much data. So that's one of them. The second one is when you have plenty of data, but the distribution is changing. So in the first one, you're insuring something, just not much history. So that could be earthquakes. We haven't had that many major earthquakes. Could be terrorism risk. The second one was you're insuring something, but you're looking at historical data and it's changing. So global warming might be that. Maybe that historical data no longer applies because the world is changing. I mean, a good example is Florida. You mentioned Florida. People used to not live in Florida because it's hot, it's muggy, it's humid, and then we got air conditioners, and suddenly insurance companies are insuring all these houses on the coast. And there's that, wow, they're discovering it's not all that good of a risk to insure. History didn't show much. Why? Because nothing got damaged because there was nothing there. And suddenly they have all this stuff. So he doesn't specifically say that. But here, let's see which one this is. Important for insurers writing California earthquake policy, know how many quakes in the state during the past century have registered 6. This information won't tell you exactly the probability next year. That's kind of both of them, right? There's not that many earthquakes, but you really don't know what's going to happen going forward. USAA used to run a million years. People like a million years. What do you know happened a million years ago? But they need a lot of data, and earthquakes is a really good example. Is there a difference between Richter scale 5 and 7? Is it what, a 20% difference, 30%, 40%? What's the difference between a 5 and a 7? It's massive, right? It's not a straight line, it's exponential. So I think the worst earthquake was Japan, like a 9 or something. I can't spell earthquake. 9.5, I think it was in Japan. No, in Chile. Wow. I think Japan had one over 9. I forget what the 2011 one was. I don't know if it was that big, but that was more tsunami than it was earthquake, right? And so that's going to be an issue. But 9.5, well, it triggered tsunami in Japan, the Philippines. So 9.5, it's just, I can't even imagine. I've been in one earthquake in my life and I hardly even noticed it. It was in Costa Rica. It was probably like a 4 or something. All I know is a good friend of mine, he lived in Costa Rica and I was visiting, and the second he saw, he just ran out of the building, didn't worry about the rest of us telling us to do anything. It's like, why'd you run out of business? Oh, we had an earthquake. I said, yeah, thanks for telling us. But he could feel it, but I hardly even noticed it. Just felt like there was wind blowing or something. Have any of y'all been in an earthquake in here? Experienced it? Have you? Was it a really bad one or kind of minor? Yeah. So yeah, Costa Rica has them because they have 2 active volcanoes, so they have some, but they're generally not that big. US hasn't had anything like that, but obviously California is what everybody's talking about, and they could certainly have one. It'd be pretty massive, but it may not be the worst one in the United States because there are some major fault lines in Kansas and Texas. The difference is in California, they build buildings that resist earthquakes. In Texas and Kansas, we don't. So if we have an earthquake in those places, it could be far worse because their buildings are not built that withstand them. But so earthquakes can kind of fall in both of those categories. Oops, of being limited information, but also the world could be changing. Things could be worse in the future than they have been in the past. So that's a really critical one. And then the last thing you do on the paper, here he talks about what we do know. We'll talk some on this. I don't think you may not agree with him on all of that. But the last thing I'll have you do is take this very last page. It's actually page 10. No, it's not page 10. You're going to read through, well, you read through 12. I think it's 6 through 12. But here, these 2 paragraphs I find really, really interesting. We'll get into these more. I think it's bizarre what he does. You may disagree with me. I want to hear your opinion, but he's talking about we got to be careful. We got to have more data. We can't insure stuff we don't fully understand. Then you come to this page 10, it says, oh, and now we're really aggressive. We're doing all these new risks. We're insuring terrorism risk on oil rigs in the ocean. It sounds like, wait, is this the same article? Did someone else walk in and start writing the rest of this? I think it's bizarre. You may disagree, but he's bragging about these massive risks they're insuring on stuff that sounds like, how do you have data on that? So we'll see if you agree with what I kind of my confusion when you get into this. I mean, it's not, he's been talking about we got to be more careful, and then he does, man, this guy's been really busy. They're insuring airlines, all sea platforms, Sears Tower, which is not even a Sears Tower anymore, including terror. What did you just say about terrorism? We insured terrorism, didn't have good data. What are they doing? They're insuring terrorism again. But yeah, I mean, it just sounds really, really aggressive, big numbers. I mean, look at that. Does that sound like they're really careful now? No one can match the speed which he offers these huge policies. Does that sound a little weird? It's like, wait a minute, what do you say? But some students say no, they think what he's saying is fine, but it is interesting. So anyway, 6 through 10, you'll be able to tell as we get through it. There is one section he talks about. We'll get into it a little bit, but it's really not part of the paper. And that's his discussion on loss development. We'll talk about it because it's a really interesting topic, but that part doesn't belong in paper 1. It's just an interesting topic that'll come up later in the class. He doesn't, you notice loss development is in quotes. We'll talk about why it's in quotes. It's a term he doesn't like. He thinks it's a euphemism for whoops, we made a mistake. But anyway, that's his topic. So if you look at Canvas, you can go to the paper description, you'll find in there a rubric, or at least my version of a rubric. So here's the rubric. %10 of the paper is other research that you need to do, which is part of the critical thinking. And here's what we're going to do. What I recommend you do is read pages 6 through 10. Just read through them. Then look at the rubric and read 6 through 10, looking at the rubric so you can find those. So remember, he had how many in his list? 3 things. I've got 6, and then number 6, we're going to break in to kind of 2. So we really have 7. So his 3 become 7. And his third one, I think it's important, but it really doesn't apply to this class. His third one is deal with ethical people. I think that's true for every business, not just insurance. So that one is just a gimme. Just put that one in there. But we're going to talk through these so that you really, really get into what he's saying. I think it's really, really well written. I would give you a more recent version, but he never got back to this this level of intensity that he had coming out of 9/11. They did lose quite a bit of money in 9/11. This is not Geico. Geico didn't lose anything, but this is their reinsurance company, Gen Re or General Reinsurance Company. Y'all know what a reinsurer does? Property casualty side. So your deductible for your auto insurance might be $500. The deductible for Gen Re might be $5 billion. Really high deductibles. So what did they do? They insure the extreme event. They say, okay, you have this building, or have these buildings. We won't pay you anything until your losses hit $5 billion. So what does that mean? They're insuring the extremely low frequency, high severity events like terrorism risk, like major earthquakes, those kind of things. That's what reinsurers do. Very different type of business, which means most of the time they make a lot of money, and every once in a while they lose a lot of money. And so you just kind of see this, wow, this is a great business, great business. Oh, whoops, what happened? So that's what he's addressing in here. They still make money, but he said what happened in 9/11 shouldn't have happened. They shouldn't have lost that much money in 1 year. That was way too much. We'll get into that. He will use the terms like float, obviously, and the cost of float. Be really careful on these terms. Some students say the float, we'll get into it. It's tough. Float is hard to define. Some people say the floats, that's the investments that they make, but that's not what float is. Float is not on the asset side of the balance sheet. It's on the liability side of the balance sheet. So we'll see. He actually defines float as something on the balance sheet. It's their actual reserves. And the key to float is time delay. You got to get that in your answer. And we'll get into that more. There is no float unless there's time delay. So what's the time delay? You pay your premium today, and then over time you have claims. That's what float is. It is true that the benefit of float is you get people's money today, you get to invest it. So you're investing the float, but the float is not the investment. The float is the money you have, other people's money. So be real careful. His definition is a little bit kind of too short. You can't get away with this on the paper. You got to get a little more than that. Float is money we hold but don't own. That's true, but that's not a good definition. What might be another definition for float? What's on the liability side? What's on the liability side? Debt. Float looks a lot like debt. He kind of views it when you pay your insurance premium, it's like you're loaning him money and he's going to pay you back with claims and expenses. So that's float. Float is the actual reserve they set up for money they've got. They haven't paid you yet, but they think they're going to pay you in the future. That's the float. What's the cost of float? That's where the term combined ratio comes in. Let me give you combined ratio real quick, just so you have a sense of it. So as you read the article, I can't remember if he uses the term combined ratio in here or not. That's not it. Nope, nope, nope. He doesn't use the word combined ratio, but he hints at it. Let me just start a new page. So a combined ratio basically is outflow divided by inflow, which equals claims, LAE, and expenses divided by premiums. So it's what they pay out divided by what they bring in. If their combined ratio is 1.05, or if the combined ratio is 0.95, which of these would be better? Would you want a 105 or would you want a 0.95? 0.95, right? 105 means what? You paid out more than you took in. So combined ratios, I'll show you the industry's combined ratio. Believe it or not, even though this is a statutory number, it's not on GAAP financials. The Bloomberg machines actually have combined ratios and loss ratios available. So 1.05 is what we call an underwriting loss. A 95 is an underwriting gain. That's where he talks about he's borrowing money at negative 5%. He's taking in $100 and only paying out 95. Plus, there's a delay. So he's also making money on top of the $100 in the investment side. So you give him $100, he invests it, makes another $2, pays you 95, he makes $7. You notice the combined ratio excludes investment earnings. Combined ratio is only the underwriting side, the insurance part. All right. What happened to Berkshire Hathaway? Well, their normal combined ratio was about 95, and suddenly in 2001, it jumped up to like 120. Suddenly you had these really, really large losses. So the combined ratio is the loss ratio plus the LAE ratio plus the expense ratio. Not exactly that, it's a little bit off. So the loss ratio is how much you're paying claims divided by your premiums. The LAE ratio is your loss adjustment expenses. That's all those claims adjusters that go out and look at your house and all that. That divided by premiums. Your expense ratio is all your other expenses. And When you add those together, you get the combined ratio. The only tricky thing that's really not that important to us is the number they use for premiums is not exactly the same on those three. Sometimes they use written premiums, sometimes they use earned premiums, but we don't really care too much on that. It doesn't make a big difference in the numbers. And so what I can show you, and I will show you, I need to update the file, but show you some loss ratios, LAE ratios, expense ratios, and combined ratios for the entire industry. And you'll see for a typical auto writer, they typically write about 95. For reinsurers, they can write pretty low, like 70, 80, and then suddenly it's 120. Homeowners are pretty low. They look really profitable, but homeowners have massive losses all at once because of hurricanes and fires and those kind of things. Homeowners look a lot like reinsurers, where they have a lot of good years and then bad years. And then there's one industry that has an underwriting combined ratio of 0.05. How does that sound? You give them $100 and on average they pay you $5. That sound like a good business? Be good for you, right? But what about as a customer? It's not too good. You may know what business that is. It's not auto, it's not homeowners, it's not commercial. No, this is all property and casualty. Life insurance doesn't have combined ratios or loss ratios. No, not the liability side. Liability looks almost more like the homeowners where it can kind of jump around. So it's my least favorite insurance of all insurance. Yeah, even Sophia and Peyton, Miles, y'all won't believe this, Aaron. I actually like it less than equity-linked annuities. Y'all believe that? Any guesses? Title insurance. I think title insurance is a scam. If I can find something, if any of y'all work for a title company, you want to argue the other side, bring it on. We'll have a debate. I'll argue why I think it's a scam. I think it's the most overpriced insurance in states. One state, their title insurance is about 90% lower than Texas. I hate title insurance, and we'll talk about why. I think there's of no value to you of title insurance. The entire value goes to the bank, but you have to pay for it, even though you get no benefit from it whatsoever. So, and you can kind of tell from loss ratio, I mean, from ratios, they pay out very, very little. That was actually the loss ratio, not the combined ratio. Sorry, the loss ratio. So you give them $100 on average, they'll pay you $5 back. We'll talk about title insurance in here. The insurance industry doesn't actually offer title insurance. It comes by special title insurance companies, but I wish it did. I really wish State Farm and Allstate and USA could sell title insurance because I think the rates would fall 90, 95%. In fact, I think it would almost be free. It'd just be thrown in with your homeowners and maybe that charge you an extra 2, 3%. So this is important though. So for right now, and we'll get into this, what we'll do is next Monday, we're going to talk the Berkshire Hathaway paper. We won't do it. Well, we don't have a class between. So next Monday, so between now and Monday, read those 6 pages and we'll get into detail on paper 1 and then we'll get into economics. We will do a seating chart on Monday so I can start learning your names. And then we'll also start attendance on Monday. Any questions on anything? All right, I'll see y'all. I will put the video of the class up usually every Friday. So if you miss a class, you can watch it and send me your notes.